A diversified investment portfolio is a collection of different types of assets that are designed to reduce risk and maximize returns over the long term. The concept of diversification is based on the idea that not all investments will perform well at the same time, so by spreading your investments across different types of assets, you can reduce the overall risk of your portfolio. One of the main advantages of a diversified investment portfolio is that it helps to reduce the impact of market volatility. For example, if you have all your investments in one particular stock or industry, and that stock or industry experiences a downturn, you could lose a significant portion of your investment. However, if you have a diversified portfolio that includes a mix of stocks, bonds, real estate, and other assets, the impact of any one particular downturn is likely to be less severe. Another advantage of a diversified investment portfolio is that it can help to maximize returns over the long term. By investing in a mix of assets that have different levels of risk and return, you can create a portfolio that is designed to provide both stability and growth. For example, you might invest in a mix of stocks, bonds, and real estate, with the aim of achieving a balance between long-term growth and short-term stability. When creating a diversified investment portfolio, it is important to consider your investment goals, risk tolerance, and time horizon. Your investment goals will determine the types of assets you should include in your portfolio, as well as the mix of assets that will best suit your needs. For example, if your goal is to generate income, you may want to include a higher percentage of bonds and dividend-paying stocks in your portfolio. On the other hand, if your goal is to achieve long-term growth, you may want to focus more on stocks and real estate. Your risk tolerance is another important factor to consider when creating a diversified investment portfolio. If you are comfortable with taking on more risk, you may want to include a higher percentage of stocks and real estate in your portfolio. However, if you are more risk-averse, you may want to focus more on bonds and other fixed-income assets. Finally, your time horizon is also an important consideration when creating a diversified investment portfolio. If you have a longer time horizon, you may be able to take on more risk in your portfolio, as you have more time to ride out any market downturns. However, if you have a shorter time horizon, you may want to focus more on stability and preservation of capital, rather than growth. In conclusion, a diversified investment portfolio is a critical component of any long-term investment strategy. By spreading your investments across different types of assets, you can reduce risk, maximize returns, and achieve a balance between growth and stability. When creating a diversified investment portfolio, it is important to consider your investment goals, risk tolerance, and time horizon, in order to ensure that your portfolio is tailored to your specific needs and objectives.